Hey everybody, welcome back to Chipstock Investor. We're going to cover a very important topic today, the IPO or upcoming IPO of CoreWeave.
Is it really that important?
So important. We get so many questions about CoreWeave. So yeah, it is important to our investors.
Okay. If it's important to you, it's important to us. We're that kind of YouTube channel.
So why exactly is CoreWeave a big deal? Let's take a look at Gartner's worldwide public cloud services end user spending forecast for the 2024 to 2025 years.
And the reason we start here is this is part of our top-down methodology for deciding whether or not we're going to purchase a stock. And so we start at the high level here. And when we're talking about CoreWeave, what this fits into is cloud application infrastructure services, at the first row in Gartner's table, and cloud system infrastructure services. Both of these areas are expected to be some of the highest growth parts of cloud computing in 2025, north of 20% expected revenue growth over what was already a fantastic year in 2024. And Gartner itself acknowledges that GPUs, accelerated computing, AI, whatever you want to call it, infrastructure for all of that is what is driving this very rapid pace of expansion.
Before we continue, quick shout out to the sponsor of today's video, FinChat. And FinChat we used pretty heavily when researching CoreWeave. Nick, how do we do that?
Yeah, usually when you see FinChat.io in our videos, we're showing you financial charts to show you metrics that we follow for the businesses that we research and that we own, especially key performance indicators for that business. But FinChat actually has a lot of other great tools that lend itself for analyzing a business like this. Because at this point, CoreWeave is still a privately held business. We have limited financial data, and most of that is buried very deeply in S1 filing, an IPO filing. So the FinChat Copilot can be a great tool if you have a framework like we do, which we encourage all investors to develop one. If you have a framework, you can use Copilot to ask questions and extract the relevant information to you from that very dense, not so interesting or exciting SEC document.
If you think 10K filings are bad, look at an S1.
Hype on the front, very verbose and dense, important information that probably contains some red flags. So that's the problem with S1s. Check out finchat.io/CSI.
You can get 15% off any paid plan with that link, finchat.io/CSI. Check it out in the video description below. Thanks, FinChat. One of the first things that we look for in our top-down methodology, our framework, is the competitive advantages that a company might have. And when you look in the S1 IPO filing, this is the statement that's made by CoreWeave. They say, our deep relationships with customers are a competitive advantage, and our first-to-market track record with highly performant technology gives customers confidence in choosing CoreWeave.
Yeah, actually, this statement pops up a few times in the S1. So CoreWeave thinks that this is far and away its strongest competitive advantage. Boiling it down, basically, they think they're first to market with Nvidia GPUs, specifically for AI training, is what sets them apart. Now, in thinking a little bit about CoreWeave's history, there are some oddities here that are not completely dissimilar from other cloud infrastructure providers that have popped up. This like GPU centric cloud provider or neo cloud providers, you'll often see them called. CoreWeave actually got its start in 2017 offering Ethereum mining, crypto mining services, and then made this pivot to AI a couple of years later. So their first to market strategy, really, I think what that means is they are able to get their hands on Nvidia GPUs before other providers were able to. That's really what we're talking about here.
Now, if you have no knowledge of CoreWeave, like I did previous to deep diving into this company, tell me about what exactly CoreWeave is doing with those Nvidia GPUs.
Yeah, obviously all on their own. Very few developers can make use of these GPUs, or sometimes that's called bare metal in cloud jargon. If a company is offering just raw computing power, So what CoreWeave does to make its services more attractive and more usable is it adds this software stack on top of those GPUs so that computing power does something. And in this case, it's primarily for training these very large AI algorithms. And so, of course, there's not a lot of embedded competitive advantage even in this. So what companies like CoreWeave have to do is they have to keep adding new software services on top of that infrastructure to stay ahead of the competition. And this is what brings us to perhaps maybe the first reason they're choosing to have an IPO and raise cash is they're going to make an acquisition.
Yes, this announcement was made right after the IPO filing. This was on March 4th. CoreWeave announced that they are acquiring the company Weights and Biases. Weights and Biases is one of the key players in the machine learning and large language model operations software ecosystems.
Yeah, a lot of small software providers like this involved in this type of work. Nvidia itself has acquired a number of startups like Weights and Biases to offer its customers a way to manage those GPUs. CoreWeave also in competition with Nvidia a little bit in here, as well as other neo cloud providers and other just cloud providers, period. Paying a pretty hefty price tag, more than likely. The rumor is the acquisition is going to be for approximately $1.7 billion. Now, we don't know if that's going to be in cash or in new CoreWeave stock or a combination of the two, but likely Weights and Biases is only generating tens of millions of dollars worth of revenue every year. Hefty price tag to be paid in this space. It's not just the GPUs that are in high demand, but also the software to manage them. So this is the big disadvantage for a company like CoreWeave in a very fast moving, fast growing, but also fast moving industry. You have to spend a lot of money to try to stay ahead of the competition.
CoreWeave has been able to stay ahead of the game in a couple of different areas. They have this slide specifically discussing the MFU gap or model flops utilization. That's a mouthful. And honestly, this slide is probably going to be outdated here very quickly because of the advances in this technology.
Yeah, things moving very quickly. So I think for your average investor, slides like this certainly ratchet up the hype around a company like CoreWeave, but all by itself, no reason to go invest in the business. But model flops utilization in a nutshell is just referring to the efficiency of the GPUs in CoreWeave's data center in training AI or in operating the AI algorithms that customers are running on that CoreWeave infrastructure. So if this is completely confusing to you, you're not completely clear what the technology is, what this terminology means, a great way to just get a feel for whether or not this is actually true or if it's just nonsensical hype, you can look at the financials to judge whether or not customers believe CoreWeave is actually a good technology stack to be utilizing in the first place.
So far, it looks like the answer is yes. Customers do see value in CoreWeave. Just a few years ago in 2022, CoreWeave had a revenue of around 20 million. And now in 2024, they're saying 1.9 billion for annual revenue.
And the really interesting bit about all of this is it looks like this revenue growth can continue. So just 1.9 billion roughly in revenue last year, but their remaining performance obligations or RPO, this is not an actual hard and fast financial metric. This is not money in the bank, but these are customer contracts with an average duration of about 4 years out. Those total contract values are over $15 billion. So it seems as if CoreWeave's very fast revenue trajectory can continue. But let's delve into this a little bit deeper because remember we said at the front end of an S1 filing is where you'll find all of the, yeah, look how awesome we are. We are very deserving of your hard-earned cash. But let's maybe delve into this a little bit more and read between some of the lines here. Let's first talk about the business model itself. What exactly is a neocloud? Let's talk about this a little bit more specifically and CoreWeave in particular?
CoreWeave is building this neo cloud or GPU centric AI infrastructure, purpose built for AI infrastructure. And of their total deployed GPUs, which are over 250,000 as of December 24th, the majority are Nvidia Hoppers. CoreWeave goes on to say that they were among the first cloud providers to deploy these high-performance GPUs from Nvidia, the H100 and the H200, as well as the Grace Hopper 200, and the first cloud provider to make the Nvidia GB200 NVL72-based instances generally available. What that means in short jargon, that's the most recent Blackwell platform. And we talked about this specifically in a recent Nvidia video, which we'll link right here.
And in addition to just buying Nvidia GPUs, CoreWeave has invested in that software stack on top of it to try to make their platform as easy to use as possible and attract more dollars from their customers. Some of those software services are mission control and observability so that the customer can monitor the performance of the GPUs when they're training a model. And of course, they're going to be trying to bolster those capabilities with the acquisition of weights and biases that we already discussed. So that's the business model, Casey, but we need to talk about the competition because this is another key issue for a would-be investor in CoreWeave.
Now, if you remember back at the beginning of the video, we talked about what the competitive advantage that CoreWeave said they had, deep personal relationships with their customers. When you're thinking about the competition has deep personal relationships with those customers as well, because we're talking about big companies like Amazon AWS, Google Cloud Platform, IBM, Microsoft's Azure platform, as well as Oracle. And in fact, some of these companies are also customers of CoreWeave.
Yeah, we'll get into that here in just a moment. But if you're still struggling to try to understand what exactly this means, think of cloud infrastructure as a type of modern utility. So AWS, Azure, Google Cloud, Oracle, IBM, even Meta is not mentioned in the S1 filing for CoreWeave, but Meta, also one of the world's most powerful data center computing platforms. And they, of course, have these open source models, the Llama AI models that they're making available for customers as well. Not hard to imagine a company like Meta deciding to compete in this, let's call it modern utility market. And so like you just said, Casey, all of these companies also trying to purchase as many NVIDIA GPUs as they can, package them up with a software stack, and also offer them to CoreWeave's customers. And as CoreWeave mentioned, in this race to acquire NVIDIA GPUs, some of this competition is also their customer. And this is an important point. Hold on just a second. Let's talk about the other neo-cloud competitors, in addition to the big names that we all know and talk about almost every time we have a video on Chipstock Investor.
Yeah, some of these smaller players you can see on the left side, we have the publicly traded companies Nebius. That's one that we've been asked about pretty frequently in recent weeks, as well as Applied Digital and DigitalOcean. And then on the right, two privately held companies, Lambda and Crusoe.
And remember, we mentioned CoreWeave started out as a crypto mining company. This is actually a commonality they have with Applied Digital, which we've been critical of in the past. Nebius, the early use case for these GPUs was cryptocurrency mining. And so you'll see this common trend among some of these neoclouds that when the crypto mining craze wore off in 2018, 2019, there was still use for NVIDIA GPUs, so they made the pivot to AI training, and it probably speaks to the power of NVIDIA's general purpose accelerated computing. Final takeaway here from this, though, is this is a very crowded space, and there are probably going to be other cloud infrastructure providers that enter this race before we wave the checkered flag on this rollout of AI infrastructure.
And to go along with what you just said, Nick, customers of CoreWeave want NVIDIA GPUs. They state this, that all of their GPUs that are currently used in their infrastructure today are NVIDIA GPUs. And in fact, their customers have contractually specified that they use NVIDIA GPUs. That's how integrated NVIDIA is in this whole process.
And so CoreWeave does talk about its expanding fleet of data centers, most of which are probably co-location facilities, rented space from a company like maybe Digital Realty Trust or Equinix. So they'll talk about the expanding fleet of data centers they have offering these GPUs. But really, I think the takeaway from this is the real power of this platform isn't specifically CoreWeave, but just that they were able to get their hands on these GPUs a bit earlier than the competition.
Now, previously we mentioned that some of their customers are actually competitors for CoreWeave. And this is an interesting point from the S1. They recognize approximately 77% of their revenue from their top two customers. That was in 2024. And in 2023 and 2024, their largest customer was Microsoft, a competitor.
Yes, 62% of revenue last year from Microsoft alone. And again, this probably speaks less to the strength of CoreWeave and more just to the strength and just the sheer demand for Nvidia GPUs, and also Microsoft's inability to keep up with that demand, having to cut these very exotic deals to get enough infrastructure in place for the demand for their own accelerated computing infrastructure and software development. And of course, it'll be interesting to see how this plays out with the rumors that Microsoft has been canceling some data center leases due to their evolving relationship with OpenAI. If Microsoft maybe runs into this patch of having built out too much accelerated computing infrastructure, this could be a big hit to CoreWeave's trajectory in 2025.
We'll use our semiconductor industry flow to help illustrate the type of pressure that CoreWeave is under from both sides of the playing field. Nvidia, which is providing the ingredients for what CoreWeave is serving up, and then a company like Microsoft, who's purchasing from CoreWeave, but also in competition from CoreWeave, focusing on that enterprise and consumer software portion of the business.
Yeah, and this is interesting because we like cloud infrastructure businesses. The economics are fantastic. Obviously, look no further than Amazon AWS. Microsoft Azure actually has breathed new life into Microsoft in the last 5 to 10 years. Google Cloud now offering a very large chunk of profitable growth for Alphabet. Oracle Cloud, and the list goes on and on. But for these neo clouds like CoreWeave, they are in a unique and not so enviable spot at this point where it seems like the cloud economics could eventually work in their favor like it has for the traditional cloud. But as of yet, those customers also being their primary competition, I'm not so sure that we can say that the unit economics are going to play out the same as they have in the past for AWS at all. But let's talk about this last point a little bit further, because there are signs that maybe I'm wrong about that. Maybe the unit economics really are going to be that good for CoreWeave as well.
Yes, they could, Nick, because of these remaining performance obligations or long-term contracts. CoreWeave says that they have some of the world's leading AI labs and AI enterprises as part of their customers, and those RPOs going out multiple years. CoreWeave said at the end of December 31st, 2024, they had $15.1 billion in remaining performance obligations, which would be an increase of 53% from 2023.
Now, two issues with using RPO as a way to measure future growth. RPO is cancelable, typically, is not money that has to be spent by those customers. So that's issue number one. Issue number two, 53% RPO growth is impressive, but it's not a 7 or 8x increase in revenue like CoreWeave reported from 2023 to 2024. So if RPO is a future indicator of actual revenue growth, it seems like we're not going to see triple-digit revenue growth for much longer for this business. So that's the two-part issue we see with RPO as some sort of indicator for CoreWeave's trajectory into 2025 and 2026 after this IPO is complete and they start publicly reporting their financials on a quarterly basis. That said, Casey, it was a pleasant surprise to open up the S1 and see there was actual GAAP operating income last year at CoreWeave.
And a lot of it, $324 million in operating income. And the previous 2 years were in the negative. So this is really positive.
Yeah, maybe the economics really do work for this. However, asterisk, big asterisk.
Net cash provided by operating activities, that's the first line we have highlighted, $2.8 billion. But then drop your eyes down to the second line where we have CapEx, purchase of property and equipment, including capitalized internal use software. Almost $9 billion in 2024. That's a lot.
What that means is money flowing into Nvidia's coffers, revenue for Nvidia. That's what CapEx is from CoreWeave. So what this means for CoreWeave, looking at something like negative $6 billion free cash flow headed into 2025. And so if you're looking at the balance sheet, cash and equivalents on hand of just shy of 1.4 billion. Here's another reason why they need to IPO. They need to raise more cash so that they can keep purchasing those GPUs, that infrastructure to fill up their data centers. And if you recall back to 2023, CoreWeave was that company that was brought up by a lot of investors as having issues because they were raising debt and using the Nvidia GPUs as collateral. Some investors called this fishy. Not really. That's just how debt works. That's how a bond works. When you own a bond of a business, the business's assets, in this case, Nvidia GPUs, are your collateral. If the business goes belly up, what you get in return is a bunch of Nvidia GPUs. So nothing weird about that. This is just how banking works. But the point here for CoreWeave is it looks like they are very much in need of cash. And so the IPO is happening. They're probably going to need to raise more debt, or maybe they keep issuing more new stock to pay for things like GPUs or more software acquisitions like the weights and biases purchase that we mentioned earlier on. And so finally, let's talk about valuation.
For CoreWeave's IPO, the targeted market cap is around 35 billion and enterprise value of about 40 billion. That's market cap plus net debt. So this would imply an over 20x price to enterprise value and over 120x operating income to enterprise value. So hefty price tag for CoreWeave.
Yeah, most certainly. And a hefty price tag you should only be willing to pay for if you think this very rapid scale up of the infrastructure can continue, if customers keep spending lots of money with CoreWeave, and if the unit economics continue to improve. What we would be looking for specifically is seeing a very, very dramatic decreasing of the free cash flow losses later in 2025 and into 2026, all the while CoreWeave continuing to show progress on operating income and operating profit margins. So that's what we'd be looking at to justify this high price tag. And so I think the question now becomes, for probably the many viewers that have skipped to this final point of the video, is this something we're buying or not? If you did, please go back and watch the actual research. But are we buying, Casey?
Well, we have a rule, not a hard and fast rule, but a mostly hard and fast rule about not buying a company that's IPO'd until at least a year. But this one could potentially be different for us. We may be interested in this one at IPO.
And if we were, it would be a very, very small starter position. And the reason why we might be interested in purchasing a very small position is because we have lots of cloud infrastructure providers already in our portfolio. We own ample amounts of Google stock, of Amazon stock. And one of the primary reasons of owning those, especially Amazon, is AWS. We also own a little bit of DigitalOcean. That's still part of our small cap basket, but we don't have any pure neo cloud provider. So maybe we just buy a little bit of CoreWeave and see what happens. If the valuation goes even higher and it starts looking completely absurd, it will just, I suppose, just take the profit and invest it back into Amazon AWS. And if it flops, it's a very tiny position. It would be possibly a very tiny position.
We haven't made our final decision on CoreWeave. We still have some time. The IPO will most likely be in a couple of months. After that S1 filing, we'll see when the date gets set. However, we will let our semiconductor insiders know what our final decision is on this. So if you're interested in that and our discussion on all things on all of the companies that we own in our portfolio, check out our Semiconductor Insider membership. Link to that in the video description below. Thanks for watching this episode of Chipstock Investor. Make sure you sub to the channel, hit the like button, share with your friends, and if you're interested, we have a free newsletter that we just started. So we'll put a link for that in the description below as well. See y'all soon at Chipstock Investor.